Work, work, work. That's our topic for today's Backstage Pass. Well, happy Friday, everyone. Stocks and mortgage bonds are down today again. This is the fourth straight down day for mortgage bonds. And look, the markets are looking at the jobs data that everybody's been waiting on all week, all right? So we got the BLS Jobs Report. And the headlines that we're looking for and the markets are watching in this report, well, it's the unemployment rate and it's the number of jobs that were created. So unemployment rate for the month of September dipped from 3.7% to 3.5%. 3.7% was what was expected. It was expected to stay the same. So it came in lower than what was expected. And in the month of September, there were 263,000 job creations. That was higher than what was expected. It was expected to be about 250,000. So that came in higher than expected as well. A little anecdote on the jobs creations. A vast majority of job creations came from a demographic of 45 years or older. All the other categories, most of the other categories saw losses. So it's kind of an interesting anecdote there in the data itself. But look, if you're, for the people that like to eat food and have a place to live and things like that, well, more jobs is great news. It's, more work is great news. But for people who like low interest rates, well, more jobs is not that great of news. And as a matter of fact, because the Fed is watching this jobs data to help determine policy and whether or not to make a policy shift, well, the stock market's kind of reacting adversely as well, because the stronger jobs data means that the Fed will most likely continue a more hawkish stance on their tightening by raising the Fed fund rate, and the stock market didn't like that. And for the mortgage bonds, well, mortgage bonds are looking at this saying, hey, the Fed's efforts are not having enough of an effect yet, so we're still waiting to see some of these indicators that inflation is going to come down. Stronger jobs means that it's not working out just yet, and so mortgage bonds are down as well. Mortgage bonds are down 17 basis points at the time of recording. 10-year yield is up about 4 basis points. Yesterday, the national average for a 30-year fixed rate, well, that came in at 7.03%. Today, we're expecting that to be a little bit higher. And while we can't control the data and we can't control how the markets react to the data and all that kind of stuff, it's like we've said before in the past, we can control what we can control. That's our effort, our attitude, our focus. So I just want to remind you, that's all the news that we have for today and this week. We just want to remind you, stay positive, max effort, good attitude, focus on the positive, stay positive, have a great weekend. We'll see you on Monday.